affected. And we have a situation here from the affordability standpoint, Bruce, that is a little like what we're experiencing with the consumer and interest rates. In other words, affordability is not that out of whack, but when you compare it to what the affordability was just 2 short years ago, 17 and 18% of total income required for housing costs, now 29, even though it's only 2% above kind of the long-term average, it feels like a lot more, right? It feels like a true burden in terms of the cost of home ownership. And that's the challenge for mortgage companies and the real estate industry is kind of like you said, Bruce, like if we're already in a recession for our industry, right? Much fewer units, much fewer mortgages, and then the whole economy goes into a recession for however long that might last. Again, you've demonstrated and illustrated here that even the longest recession, since the Great Depression in 2008 only lasted 18 months. But you kind of have this triple whammy. You've got like units slowing down in real estate and potentially then an overall economic recession, and then potentially the further decline of the stock market even beyond that. These things take quite some time to really play out. And regarding the red ink, the longer it goes, the harder it is for some of those companies that are barely getting by to make it, right? They're spending their reserves, they're borrowing if they can, they're writing checks and bleeding red ink. Well, you can only bleed so long before you're just dead.
Right, Chase. When you look at what the investors are doing, right, the people who go out and buy the treasury bonds, they basically said no to the 10-year treasury notes after they saw this tight labor market information and the rising wages, right? Because they're really the drivers of inflation. What it's doing is it's sending yields, which, by the way, climbed as much as 14 basis points to a high of 4.49. And that's a level not seen since October of 2007, right? And of course, we know what happened in 2008.
Yeah, we do.
Yeah. So I think this is going to be interesting to see what ultimately comes of this because, as we've said numerous times on this podcast, it's not the federal funds rate which actually drives mortgage rates, right? It's the 10-year treasury yield.